Options can be used in a variety of ways to suit an individual's investment goals and risk tolerance. They can be used to speculate on price movements, generate income, or hedge against potential losses. For more on how investors can use stock options to gauge price movements and profit from market volatility, let's get to Simpler Trading's VP of Options, Danielle Shay, for the basics. This segment is sponsored by Tasty Trade. Danielle, great to have you here with us this morning. First and foremost, why would a person choose to have options in their portfolio versus or in tandem with some of their equity holdings?
Well, personally, I like to use options to leverage the stock market. So when you're looking at trading options versus trading stock, one major reason why people will get into it is because you can use a significantly less amount of money to actually get into the stock market. So for example, when I first started trading, I started trading with a $5,000 account, and I was able to make trades using $100 to $500 per trade. Whereas if I was trading stocks, I would have needed thousands of dollars to make the same impact.
And Danielle, with increased leverage, of course, comes increased risk. Maybe you could give our viewers some of the risks attendant to trading options that you might not have when you're trading just equities.
Yes, absolutely. So trading options is inherently risky. And what I like to tell our subscribers and our traders is that whenever you're going into an options trade, you need to go into that trade understanding that that's money that you can lose, specifically when you're looking at the time frame that you're trading. Personally, I'm a pretty aggressive trader, and what that means is that I'm trading on usually a 3-week or less time frame. And so that means that the options that I'm trading are going to expire in 3 weeks. So when you take that into account, you need to think about how much money you're putting at risk. Typically, what I like to say is that I'll risk about 1% to 2% of my account on an overall trade, knowing that, if the trade doesn't go my direction over the course of those 3 weeks, then yes, that is money that you can lose. That's why you have to look at your overall risk tolerance and your overall financial plan to think about if that's something that works for you. But for me personally, being able to take on, 1% to 2% risk per trade on my overall portfolio on about a 3-week time frame, for me, I love being able to capture the leverage that options provides.
Okay, so I imagine that you're sitting in front of your computer, multi-screens, rubbing your hands right now because that 3-week time frame, that cues you right into earnings season as well. How are you using options data to really get a glimpse of how a stock may move when they do report earnings?
Yeah, so one of my favorite times to trade options is going to be during earnings season. And the reason for that is because options are priced on a variety of different ways. And one of the ways is the implied volatility. So the pricing in options is going to go up when implied volatility goes up, and implied volatility is going to go up going into earnings season. This is because there's more volatility around earnings. And so when you know that the price of an options contract is going to go up going into earnings season, what I like to do is I like to time that, and I like to buy those options prior to the earnings report and trade them up into the report. Now, options will go up when implied volatility is going up, but they're also going to go up if, of course, the underlying stock price is going up. So ideally, what you like to do during earnings season is have both of those factors working together. So if you can find stocks where the underlying stock price is going up in addition to the implied volatility, then that can be a really good time to actually buy premium in the options market. But I will tell you that you do need to generally get out of those options prior to the earnings report, because after the earnings report comes out, the implied volatility is crushed. And that means that that options contract is crushed as well. So generally, I like to buy premium going into earnings. And then once you get to the earnings report, I like to actually sell premium to trade that volatility crush.
Danielle, we're using lots of fancy words here, premium, implied volatility. Just wondering, for a new options trader, just dipping one's feet into the waters here, how does one get up to speed on all the terminology and just kind of dip their toes in without risking too much?
Well, I always advise traders to get education, before they get into the options market. And a lot of that is going to come with options 101 education. So primarily, you can get that education online. I do write a ton of blogs. I teach classes as well, but, traders do need to understand how calls and puts work, and they need to understand the basic terminology. So for example, in the options market, selling premium is something that is very unique to the options market, and that's usually a second step. Normally, what I teach traders is they need to first understand how buying long calls works. And then they need to step up into higher level strategies such as selling premium. But the basic concept really just starts with the fact that, options are leverage products, and you can trade them using a significant less amount of money than you could just buying overall stocks. And if you can learn how to trade those in tandem with your overall stocks, that'll be much easier for you to then learn how to get into the options market.
Yes, leverage can mean more freedom and also more risk. Really appreciate you breaking that all down for us. Thank you for that. Danielle Shay, by the way.